This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Hello, this is Hall Martin with Investor Connect. Today we're here with Brian Parks, founder and CEO of Bigfoot Capital. Brian, thank you for joining us.
Thanks for having me.
We had a previous interview in which you talked about Bigfoot Capital. Can you give us a short update about yourself and what you've been doing since our last interview?
Yeah, sure thing. So I think it's been a couple of years since we last spoke. Bigfoot's been doing more of the same, which is good. I think more of the same means for us being able to find good qualities in the B2B software space and put some growth capital into them. So we've continued to do that over the past couple of years and picked up our deployment pace a little bit and are pretty satisfied with the way things have been going and have been able to experience some really good outcomes for the companies we've been fortunate to partner with. So more of the same with a little bit stepped up pace.
So let's talk about your investing experience in the last couple of years. What company do you regret not investing in, and why didn't you invest at that time?
Yeah, so I'll preface this with the fact that we're a lender. So I think our concept of regret is a little bit less so than that for equity investors. So if we miss one from a lending standpoint and it goes off to be massive, it's less painful for us than someone who said, "Man, I could have had 5% of that company," right? That said, there was one a few years back that we got somewhat close with and just weren't able to get over the line mutually. It's a company called Mural, based out in the Bay Area. It's a digital collaboration platform, which I would think of as a basically whiteboarding on steroids that they sell into the enterprise. And so, we weren't able to get there. And since that time, we've kind of, stayed in touch, watched them. They've raised $200 million in venture. That one, and we don't take warrants in our facility. So it's not that we would have benefited directly from the equity coming in, and that's in the associated valuations from that standpoint. But it would have been cool. I'm sure would have gotten paid back, and you made some good return on the capital we provided them. But would have been cool to have been along the ride there for a company that's just kind of on that path.
Great. So, what sector are you passionate about, and why?
Yeah, for us, you may find me prefacing a lot of stuff with we're a lender, but I would say, for us, we carry a pretty broad mandate under the umbrella of B2B software, predominantly B2B SaaS, but also some marketplace business models, some transactional business models, and some tech-enabled services. But we're not really all that focused on sectors. We, of course, like companies and teams that are solving hard problems and that have some tailwinds behind them. Think things like remote work and employee engagement in a remote work world, the death of the cookie and the need for first-party data and building relationships with prospects and customers beyond just having cookie data on them, and software and platforms and tooling suites that enable those types of things. I like themes of that nature. For us, what it really comes down to, Hall, is really alignment and being able to meet a company where it currently is, and then hopefully being able to provide capital that aligns with where they're trying to get to over the next few years. And ultimately, a lot of that comes down to how the founders, the exec team, and any other stakeholders involved, investors, and the board, how they're building and managing the business. So that's where we really lean in, less so than necessarily the sector, even the product application, which is, of course, important, but maybe less so than for a thematic equity investor.
Right. Well, have you avoided investing in any particular type of companies, and why?
Types of companies, yes. Sector, not as much. So, we see a lot of companies that just don't fit our mandate of B2B software, right? Could be pure B2B services, could be a consumer products company, to include e-commerce, could be any company out there under the sun that doesn't fit our mandate, that comes across our radar. And that's fine. In terms of kind of sectors, we don't avoid anything wholesale that, fits within our scope. I think for us, we bring some skepticism to certain sectors that may carry a lot of complexity, be that at the regulatory level or the macro level, or in terms of how they're addressed. But we'll still pursue opportunities in those sectors. I think for us, it's just extremely important in the scenarios that the founders and the stakeholders bring the expertise and experience that we don't, right? So that really matters in those types of sectors, if it's healthcare, government-oriented, oil and gas, something like that.
So what's your worst and what's your best experience with the startup?
Which one you want me to start with?
Let's start with your worst experience.
I gotta say, it's not related to Bigfoot, thankfully. We've had a handful of challenging, I guess, experience with some of the companies that we've funded, but nothing that we haven't been able to mutually overcome. So that's great. So I think for me, I'd probably predate Bigfoot back to Brandfolder, a company I started close to a decade ago. And that was just the founder experience and CEO experience of fumbling in the dark, searching for product market fit. So I can distinctly remember those days, even a decade ago. So I think that's just really hard. A lot of founders experience that, and that is companies can die there, companies can kind of languish there, companies can come out of that space, but it's hard, man. It's a hard one when you're kind of searching for answers and they're not necessarily there. So definitely been in that place as a founder. Best, I can't necessarily point to one with a specific company. I think, again, we've been fortunate over the past 4 or 5 years to work with a lot of companies and help them get to their next level of growth with, some capital and support from us. So, recent, and what that generally manifests in is some subsequent equity raise, venture or private equity, or some, sale of the business. We've seen a lot of those happen as well, which are really good outcomes for the founders we work with who've been able to preserve a lot of their equity, right? So they don't have to sell the thing for $1 billion or even hundreds of millions of dollars. They may sell it for 30 to 50 and walk away very well, right? And being able to play a part in those types of outcomes is great. Recently helped a founder who we've known for years and worked with for a few years raise his first outside equity round after bootstrapping for 6 years. It was his first time doing it. It's not necessarily his MO. He's more of a product engineering centric founder. I think it was probably quite uncomfortable and daunting for him. So of course it took some time, took about 6 months, but he ended up really committing to it and getting it done, right? So he's able to raise that equity round, and now be able to have the additional resourcing to invest in some of the efforts he's been wanting to invest into for the past year or so.
So, what are the challenges in the startup space today?
Oh man, I will take it, I guess, from a capital standpoint, if that's all right. I think, I'll start there at least. I think from a capital standpoint, discipline is a big challenge. There's so much capital out there chasing opportunities in software where we focus. And a lot of that capital is kind of seemingly willing to do whatever to win, which oftentimes is stretching on terms. And if that's equity, we're talking about valuations that are through the roof. Maybe if it's lending and debt, it's very light covenant structures, maybe no warrants for types of lenders that traditionally have warrants attached, or very light warrants, stretching on leverage. And I think we'll just kind of have to see how it all plays out for both returns and the risks that folks are taking to get into these companies. For operators, I think it's also, so it's very competitive on the capital side. I think it's, always quite competitive, on the operator side, right? So there's no shortage of folks continuously standing up would-be competitors to legacy incumbents, to emerging incumbents, I'll throw up air quotes, emerging players, and, to other startups. So you got to compete You got to be nimble. I mean, all the things that have always kind of existed, but maybe it's just even hyper these days. There's no slowdown in company formation, certainly. I think hiring is super hard for people, attracting talent. I don't know if the pandemic has made that worse, but it's just hyper competitive for human resources. And of course, the big companies can throw around a lot more resources than a lot of the emerging companies. I think raising capital as an operator is, I'm not going to say it's easy. It's never easy, but there's more options. There's a lot more supply out there than maybe there previously was from a whole host of players. So it's a decent time to be raising capital as an operator.
And what sectors and applications do you think are good immediate opportunities to pursue?
It depends. So I think I'll tackle this, I guess, in two ways. We're all about B2B. It's what we know. It's where we've operated. It's really all we fund, as I kind of mentioned earlier. So we focus on B2B. I think within B2B, again, we're less sector and application specific, somewhat agnostic to a degree, but thematically, some things that I like are kind of the Trojan horse land and expand approach from the product play. So maybe you've got a point solution that quickly parlays itself into something broader within the organization, across teams and across use cases. That always kind of excites me and gets me leaning in when I maybe think a company provides one thing and then they show me that they actually have a lot more going on that they can sell to customers once they've provided them with that one thing. I like verticalized plays that have reasonable adjacent markets to expand into. So I think both of those have a core theme of expansion, one product, one market. I think, again, we're kind of focused on the problem space with a prevailing theme behind it, and then working to understand the strategy and the tactics being deployed by the team that hopefully has the focus and experience to deploy them. More so than the underlying architecture, getting way hung up in the IP, so to speak, because at the end of the day, a lot of the stuff from a technical standpoint can be built by a lot of folks and somewhat commoditized. Yes, there are product moats, but it really comes down to how you, of course, execute it beyond just the tech. From a capital standpoint, I mean, questions I would have, immediate opportunities to pursue is, and for anyone allocating capital, it's really, where do you want to be, right? Do you want to invest in areas kind of akin to what we do? Do you want to be on the frontier, doing kind of the crazy moonshot type stuff? That's great. Do you want to be active? Do you want to be passive? Lead, follow? How are you constructing your portfolio? What does success look like for that? What's your time horizon? What are your return expectations? All those types of things that I think, folks can answer those. It probably becomes a little bit more evident.
Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think a couple of topics, maybe to touch on quickly, are kind of the evolution of what I'd call the SaaS capital stack, as well as the expansion of the viable SaaS capital market. So I think what's happened, we started Bigfoot in 2017. What we've seen is, a pretty big evolution and expansion of the SaaS capital stack and market. So, I draw parallels to other industries. I used to be an M&A banker, and a capital stack was generally in the picture, right? Across the stack, and different players and different objectives for those players collaborating to capitalize the company. And I think that has started to work its way into B2B software in a pretty accelerated fashion over the past few years, right? It's no longer just, hey, it's a pure play venture debt format, and you got to have raised a bunch of equity to get some debt. There's folks like us that say, hey, that doesn't have to be the case, and we're just underwriting these businesses with equity being one facet of the company and the capitalization, but we'll lend to you if you're bootstrapped, right? And even if you never plan to raise equity, that's totally fine. So, more debt offerings. I think there's stuff akin to factoring and merchant cash advance that has started to come in line within B2B software, concept of selling contracts for cash. Revenue-based financings, picked up in terms of folks' interest in it and people offering it. And then, on the equity side, so many venture funds have been stood up. Private equity funds have started to come down market, really demand these B2B software assets earlier on than they used to. search funds. There's people looking to go out and buy companies, maybe and even do roll-up strategies. There's distressed buyers of these types of assets. There's just a much broader capital market than there used to be. That I think it's hard. It is hard to navigate for founders and to understand what makes sense when and why. But basically, there's just a lot more options than there were, say, 2, 3, 4, 5 years ago.
Great. So how best for listeners to get back in touch with you?
BigfootCap.com is our website. There's a button there that says Let's Talk that can hop on my calendar. You can find me on LinkedIn, Brian Parks. I'm also at bparks@bigfootcap.com. Hopefully pretty easy to find.
We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thanks a lot, Hall. Enjoyed it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.